U.S. markets closed today for the Juneteenth holiday. So let's focus on the outlook for the TSX and some asset allocation strategy. We're joined by Stephen Harvey, Chief Investment Officer at Sagard Wealth. Thank you very much indeed for coming on.
Thanks for having me.
Sagard, ultimately part of the Power Group, but you focus on ultra net worth individuals.
Correct, yeah, families and foundations across Canada.
And people who don't want to lose money. That's the number one instruction.
Exactly the job. Our clients have already created wealth. It's up to us to kind of maintain it for them.
One area that's of interest here is energy. It's been the best group month to date in Canada. What are your thoughts on allocating money into the oil and gas sector right now?
Yeah, we really like it. We really like the Canadian names. We've been allocated there this year. A few of the reasons is, you're getting things at relatively cheap valuations. Second of all, you're starting to see a little bit of a pickup in the M&A activity. So you're seeing a little bit more going on there as well. Mm-hmm. And we always like kind of having commodity exposure in our client portfolios because you get that asymmetric upside return when things like geopolitical risks come to the forefront.
Yeah, you mentioned M&A, Strathcona going after Meg Energy, for example.
Exactly, yeah, you're starting, maybe that's a wave of deals. We decided to do a very large deal out there right now.
Well, obviously, there's a risk, though, if the trade war hurts oil prices and drags them down again. I know they have been going up lately because of the Iran-Israel clashes.
Yeah, and one of the things, I just got back from the Sagard AGM in Montreal earlier this week, and I presented 5 what I think are key signals to look out for in the markets this year, because it's incredibly noisy. But one of them is kind of the idea of kind of buying local. And we all see it at the supermarkets, but are we going to see it play out more in financial markets? Mm-hmm. The whole concept of buying local companies and thinking of sectors that are more domestically focused because they're kind of isolated or insulated, let's say, from the trade concerns.
Right. How would that apply to energy, though?
Well, you've got a lot of Canadian energy companies that are kind of captive. If they can get that energy outside of the country more, they can unleash much more value because it's largely kind of landlocked right now. And
we've heard, obviously, the Trans Mountain Pipeline has been something of a game changer.
Yeah, absolutely. These kind of things really are going to be, great stories for Canada if we can kind of get these things over the goal line.
The financials, you favour them. How are you playing that? Banks or insurance companies?
A collection of both. Like there's a few things going on with banks just broadly, globally, that make them super interesting. First of all, you've got a president in the US who's moving towards less regulation, so deregulation should be good for banks. Second of all, you've got probably going to get a much steeper yield curve here. Steeper yield curve, really good for banks. So that's something that keeps us quite excited as well. And
then lower short rates, higher long rates.
Exactly, yeah. Banks tend to borrow with the short term, lend in the long term. So a steeper yield curve is more profits for them. And then last of all, it's kind of going back to the idea of kind of staying inside their own borders. Financial companies, have a lot of regulation around them. It's quite hard to operate outside your borders. So the vast majority of their revenues come from inside their own country.
And we know that the Canadian banking industry, very profitable, typically, in terms of return on capital.
Yeah, absolutely. It's been a great kind of long-term hold for many investors here in Canada. We just think there's a lot of more going on in the rest of the world as well, in financials in particular.
When you look around the world, there are still cheaper places than the US.
Yeah, we're really excited, and one of the things is kind of look about where the flows are going to go, and the rest of the world is probably going to be the beneficiary of additional flows. And you've got to look for one thing is the valuations. You can access these markets at much lower multiples. Second of all, from a technical point of view, if there's less trade, if the US is buying less imports, then that's less kind of capital goods they have to sell to the rest of the world in terms of stocks and bonds to offset that trade. Mm-hmm. And last of all, which I think is really interesting, is kind of there's a sentiment shift going on. If you start talking to allocators around the world, they're starting to think about their own domestic markets, or at least allocating to countries outside the US. So these are slow trends that could move money away from the US into other markets.
One area you're interested in is what you're calling alternative stores of value. What kind of thing would that be? Yeah,
traditionally, investors will take those excess cash and they'll put it in US dollars, usually through the US Treasury market. And if you look at how global sovereigns do it, that's kind of what they do. But today, you're in a world where year-to-date, US dollar is down maybe 10% against the euro, 10% against the Swiss franc, and 8.5% against the Japanese yen. But the real big winner, and you mentioned at the top there, is gold. Gold has been the big winner 2 years in a row because it is that alternative store of value. And maybe you're seeing central banks around the world pivot from owning US treasuries to owning gold.
Because there is a suspicion, apparently, that the Trump administration wants a lower US dollar to improve exports.
Absolutely. It's the quickest way to clean up the trade deficit is you make imports more expensive and exports cheaper, and that helps you fix your trade balance.
Mm-hmm. And it is reminiscent of the 30s. We saw competitive devaluations back then. Roosevelt, for example, pushed down the US dollar.
Yeah, it's really interesting because if you go back to that period, the 30s and the 40s, is really when you had the pound lose its status as a global reserve currency. And right now, I don't think the US is going to lose it, but it's starting to lose some of its shine.
You two, like other professionals interested in private credit, private equity, but of course the thing is, it's so much less transparent. I, as an investor, I always have misgivings in that I can't look on the internet every day to see what the asset is priced at.
But I think that's kind of the beauty of it, is the fact, not that it's less transparent, it's just less noisy. So when you allocate money to a private business, the CFO or the CEO of those companies is not worried about the daily scorecard of the markets. Mm-hmm. They get to really focus in on building a business and creating value for you.
Yeah, I can see the logic there. I mean, it is, in a way, it's irrational. We focus on a company's latest quarter. These are complex global organizations. One quarter and one number, profit per share, is kind of meaningless.
Yeah, and the other thing is, in the US, for example, 80% of all companies that have greater than $100 million of revenue are private companies. So if you're just focusing on the public markets, there's a huge part of the opportunity set, both in the private credit and the private equity world that you're missing out on.